Hello and welcome to this video about the stock market and what you may need to think about if you have a 401k plan you participate in, or an IRA, or some other kind of retirement plan. So stick around and we'll get into this topic and hopefully shed some light on it. So if you are invested in the stock market in any way, if you own any individual stocks or ETFs or mutual funds, or own equities in any form, either directly or through your 401k plan or IRA, whether a Roth or traditional IRA or some other small company retirement plan, you've probably been very concerned lately because the market has gone through incredible gyrations, and this volatility has been about as much of a roller coaster ride in the past month or so as I've ever seen it, after spending 26 years in financial services and the last 14 years as a financial and economics writer. It has just been incredible, with both the record one-day point loss followed by the record one-day point gain. And it's a wild ride. And of course, if you look at your 401k after all the losses that we had over the last month or 5 weeks or so, where we've seen the market drop by 25%. So if you've gone online and looked at your account after that precipitous drop, or if you've gotten a statement, I don't know, some people are still getting paper statements, and you look at the value, especially if you've had exposure to the stock market and stocks the last 11 years, you were used to seeing the value of your account, your accumulated account value in those equity funds, most likely go up and up and up. And here all of a sudden you're seeing this enormous drop, and you're seeing your account value drop pretty substantially. And it is scary for the normal person to look at that. Now, especially if a person is closer to retirement, this is the reason why it's generally good not to have a lot of exposure to the equities or the stock market closer to retirement, because if you are at the point where you have to start drawing down some of these retirement funds, you may be in a position where you just can't make up those losses. But for the rest of the people, especially if you're younger, especially if you have a number of years before you need to start taking money out in retirement, then usually, and I'm hedging what I'm about to say because everybody's circumstances are different, and so this does not constitute financial or tax advice directly for you, but I am saying in general terms, what most people end up doing successfully is just not touching that money, and historically the market has recuperated, or it has come back from these tumultuous times and these big drops, and people have gained their money back. Now, depending on the amount of the loss, you generally have to earn back even more than what the loss was to get to your break-even point. But if you had been in the market the last 11 years, then luckily your values have risen substantially, and everything is relative. You're talking the market being 25% down, so hopefully since the market over that 11-year period was more than 300% up, if someone had been holding index funds during that time, they would have been able to participate in most of that big gain. So the bottom line is, the market has gone through this kind of thing before, just not to this extent. Back in 1987, when I had quite a few clients, when Black Monday occurred on October 19th of that year, and the market dropped 22% in one day, I had a lot of phone calls from people who were upset and who said, what can I do? Or should I pull my money out? And my recommendation at the time was, no, don't pull your money out, just leave it where it is. And in that case, people didn't make up for the losses immediately, but within less than 2 years, the market had recouped the losses. And during that time, since these were people in retirement plans who were paying money in through payroll reduction, they were taking advantage of a principle called dollar cost averaging. So while the shares of the funds they were paying into were still lower or depressed, they were buying into those funds at a discount compared to what the price was before the market dropped. So usually, in most cases, it's best not to do anything, to leave the money in the account, and especially at this point, instead of locking in a substantial loss and just riding it out. Now, as I've said in some other videos, and you may want to watch those as well, in the last video I did, I said we're really at a point in time in the market where we have two opposing forces determining what will happen. The market always is reacting to future events, and right now, in the midst of this pandemic, with more and more people being diagnosed around the US and around the world with COVID-19, people packing hospitals, and the situation not really at its peak yet as of the time that this video is recorded. This creates a lot of future uncertainty, something the market doesn't like, and that has been a lot of the reason, if not most of the reason, for the steep descent in the market. So what will determine when the market eventually rebounds or if the market rebounds, is how quickly this pandemic can be put to rest. How quickly can the authorities and the people in our healthcare system get a handle on this, and not only see a peak, but see cases decreasing to the point where it's safe for people to go back to work. Right now, we've just seen record unemployment filings. Now, this is after 2 or 3 years of a very strong economy. Unemployment in January and December of this year, 2020, was only 3.5%. So even with the higher unemployment as a percentage, it is still around what it was, back like in 2016, 2015, 2014. But when you take that many consumers out of the market and you disrupt especially small business to the extent that it has been disrupted, it's going to hurt the economy. And what really determines what will happen with the stock market at this point is how quickly this can be turned around. If it drags out for months and months yet, then the economy is really going to require additional strong stimulus action by the government. The Federal Reserve claims they still have some tools in their tool belt available to do something, but it really depends on if this pandemic can be brought under control in the weeks ahead. And that's really going to determine what the market does. If that can happen, if people can get back to work and get their old jobs back, if the economy can get rolling along fairly quickly and get back to where it was, then there's a possibility the stock market could come roaring back. If this drags out for months, that may not be the case. So, as I said, in most cases, the best suggestion, depending on a person's circumstances, is that they may want to spend some time ignoring their balance in their different funds, and they may want to leave their money where it is. And of course, the best suggestion and recommendation is that you should have a financial advisor who you can talk to, who can address your particular circumstances. And if you have tax-related questions, it's always good to see a CPA or a tax attorney or an enrolled agent or somebody that can help you in that area. So, hope this information is useful. Please subscribe to this channel. It is mostly about personal finance, but more recently I've delved into some topics related to coronavirus and COVID-19. I am a writer and researcher. I've written some articles on both of those topics and regularly write on economic and financial topics. So hopefully the information I give you will be valuable. If you like this video, please like it in addition to subscribing, and I will look forward to bringing you some more useful information in future videos. Thanks for watching.